Most traders focus on entries, but where you actually make or lose money is what you do after you enter. Now let's take a deep dive into how to properly adjust your stop loss and take profits while a trade is running, because this is where most traders get it wrong. So in this video, you are going to be understanding at the end stop loss adjustments, take profit adjustments, how to apply zones of interest versus risk to reward when adjusting targets, new structures, and lastly, risk management and lot sizing. Let's get into it. Stop loss adjustments. Now, when it comes to stop loss, you have two options. You either cut the trade manually or you adjust your SL based on the new price. Now, what do I mean? Now, let's say you've entered a trade already, and at some point the market actually starts making moves that means something relative to your trade. Now, when that happens, you need to adjust. When it comes to stop loss, you have two options. Like I said, you either cut the trade manually, which means that you get to close the trade by yourself by canceling the order or canceling the trade, or you adjust your SL, which is your stop loss, based on the new price action. So what do I mean? So when I say you cut your trade manually, it means that price gets to a certain point and you are like, okay, I think this trade is no longer going to be valid, and you close the trade manually and take your loss. Or you adjust your SL based on the new price action, which means that based on the new chart pattern that you are seeing, you adjust your stop loss to a particular point, which is different from the original point where you entered. So you are basically making your stop loss thinner than it was before. And like I said, this is as a result of the new price action that has happened in the market, and you need to adjust with it so as to reduce your loss and make sure that you are gaining more on your profits. When it comes to stop loss, for me personally, my trading system gives me a clear signal when to adjust, and once I get that signal, I just simply move my stop loss to where the trade should logically close if price goes against me. So like when I move my stop loss, I'm moving it based on the perception that you know that point where someone who closes their trade manually is going to be like, okay, as at this point I'm going to close my trade because I think it's been invalidated. I do not close my trade manually by myself. I rather just take my stop loss to that point and let the trade run, and if price is going to hit my stop loss or invalidate my setup, it happens and price just goes to hit that SL. So I don't get to watch the chart to make sure that I'm there to close the trade manually. So from that point, I keep watching the price after I've adjusted my stop loss to make it tighter. I keep watching the price, and the goal of watching the price is simple. It is not to close my trade manually. Like I said, I'm not watching the price so that I can close my trade manually. I'm watching the price so that I can eventually become risk-free on the trade. So I keep adjusting my stop loss as price gives me reasons to, until I reach break even. So now what's break even? Break even is when your stop loss is at your entry price, and if price reverses at that point, you lose nothing. And once you are there, you can let the trade run freely because now you are no longer at risk. Now what do I mean? Let me illustrate this. Okay, let's say price was moving and then you took an entry here at this point. You took an entry here and price moved to the upside, and you entered, let's say, somewhere here, and your stop loss was somewhere here. a take profit somewhere here. So now what I'm talking about is that at some point I could adjust my stop loss from here, from this point 1. I could adjust my stop loss to somewhere here depending on price action. So let's call this point 2. Sorry about the freehand drawing. So let's call this point 2. So I keep adjusting my stop loss until I finally get to bring my stop loss to this point. Let's call it point 3, which is where I originally entered the trade, this point. And by the time when I'm able to adjust my stop loss to this point, I mean, obviously it means that if price should eventually go up and still decide to come down, instead of going to hit my stop loss at maybe point 2 or at point 1, which was the initial point, it's just going to hit my stop loss at this point 3, which is where my entry is also. So therefore I'm going to lose $0 on that trade, or very close to $0 on that trade, because I was able to move my stop loss to break even. So I became risk free on the trade. So that's the goal of actually watching the price action after adjusting your stop loss and all that. You have to keep watching. That's for me personally, I have to keep watching because I need to at some point get to break even. When I get to break even, then I don't give a shit anymore about whatever is going to happen. I just let the trade run. It's either going to my target or it's going to come take me out at my entry point. So that's what break even is, and that's how you go about adjusting your stop loss. So having said that, we move on to the next thing, which is take profit adjustments. Now, before you enter a trade, your risk to reward should already be defined. You should only adjust based on new structures and not emotions. So what do I mean? When you get into a trade, before you even enter a trade, like I said, your risk to reward should be defined. That means you already know where your 1-to-1 target is, your 2-to-1 target is, even your 3-to-1, your 4-to-1, 5-to-1, depending on how much you let your trade run. So this thing should already be predetermined. You understand? And in these things being predetermined, okay, for example, let's say your stop loss is 20 pips. Let me illustrate this. Let's say your stop loss is 20 pips. Yeah, and your 1-to-1 target is also going to be 20 pips, because 1-to-1 means that you are standing to make what you are standing to lose if you lose. So 1-to-1 means that if I'm going on a trade and my stop loss is 20 pips, my take profit is also 20 pips. So if your stop loss is 20 pips and your 1-to-1 target has to be 20 pips too, that is, your take profit will have to be 20 pips too. For a 2-to-1, it becomes double, because that's a risk to reward ratio of 2-to-1. So instead of 20 pips for your target, you are going to have 40 pips for your target. So that's a 2-to-1. If it's a 3-to-1, 60 pips for your target. If it's a 4-to-1, 80 pips for your target, and so on and so forth. Now, here is where a lot of traders get it wrong. They start adjusting these targets based on emotions. They push it further because the trade looks good. You shouldn't let your emotions get the best of you as a trader. So adjusting targets based on emotion is a complete no. You shouldn't be doing that. And like I said, this way a lot of traders get it wrong. You shouldn't look at a trade and be like, I see this candle spike. You've already placed your risk to reward ratio, and you see this candle and you're like, because of this candle, I think this is going to go like this, this is going to go like this. And because of something we call FOMO, which is the fear of missing out on a good trade, you decide to adjust your already predetermined target, which is very wrong. Now, if you move your target from 20 pips, for instance, to 25 pips, for instance, yes, your profit increases, but that's not discipline. Take note, that's not discipline, that's emotion. And like I said, allowing your emotion get the best of you is going to mess you up in the long run. Your risk to reward should not be adjusted emotionally, only structurally. What does that mean? So it means that your risk to reward should not be something that is affected by your emotions. It rather should be affected by the structure of the market. What is the structure saying? What is price action saying? Has price giving you a reason to adjust your take profits? If there is a new structure, then you can actually work with that. But if there is no new structure and it's just a risk to reward ratio something, then you shouldn't be looking to adjust anything. Just let your profits run with the already predetermined profits. So it should never be adjusted based on feelings, like I said, but based on new structures. So let me put this straight. Adjusting your targets based on emotion, adjusting your risk to reward target based on emotion is wrong. But adjusting your target based on structure is professional. How to apply zones of interest versus risk to reward when adjusting targets. Now, risk to reward targets are fixed and should not be changed and should not change, like I said. On the other hand, targets on zones of interest can change, just like I said just now. Now, this is where actual smart adjustment comes in. You can also set targets based on zones of interest because those are areas where price is likely to react. And the best approach, to be very honest with you, combine both of them. Your risk to reward targets that should not change should be there. And on the other hand, your targets on your zones of interest that can change should also be there. So you're applying both of them to the same trade. So, like I said, the best approach is to combine both. Now, here is the important part. Unlike risk to reward targets, like I said, zones can change. So let's say your target is at $5 on an uptrend. Let me illustrate this. So let's say your target is $5 in an uptrend. So price is moving and moving, and your target is $5. The target is $5, yeah. So but halfway to getting to $5, which is at this point, let's place it at this point. So halfway to $5, price retraces from $2.5 down to $1. So let's say this is $1. Let's say this is where $1 is. And let's say this is $2.5. Oh, sorry. So let's say this is $2.5. Price retraces from there all the way down to $1 before going up to the upside. Or let's just make this point $1. Let's make this point $1 since I already drew the the caricature in this manner. So let's say this $1. So price was going up. Let's say you entered at this point and price was going up, and this is your target, $5. But before price got to $5, price retraced from this point. You understand? Now, if that retracement is significant enough on higher time frames, to understand what I said, just go back in my previous videos and you understand what I'm saying. If that retracement is significant enough on the higher time frame, then it means that 2.5 level has become a strong reaction point. This point, it means it has become a strong reaction point. So instead of waiting when price continues to now go up, instead of waiting to get to your final target at $5, you can adjust your take profits and secure most of your profit or all of your profits, as the case may be. You can secure most of it or all of it at this point. Better still, just secure most of it, because there is a high chance that price is still going to get to your target, since you already did your proper analysis and everything, and you should trust your trading system. But in this case where there has been a retracement like this, there is a very real chance that price gets rejected at this same area again. So you can have so you can have price get to this point, and instead of breaking above it, it just comes down again, and eventually it could actually reverse completely and go back all the way to your stop loss. So just be on the safe side. That retracement is the market telling you something, which was this first retracement here. It could be the market telling you something. In fact, it is definitely the market telling you something, that there is a fight between buyers and sellers at that level, and there is no guarantee who is going to win. The first rule of trading is, this is forex, anything can happen. If I scrap that, this is trading. When you're trading anything at all, just know that this is trading and anything can happen. So you have to be prepared for both outcomes. Preparing for both outcomes is what is going to make the eventual outcome irrelevant on your account P&L. Okay, I guess that's too advanced for now. So just understand what I'm trying to say, which is that you don't always have to wait for price to reach your final target when it comes to structures. But let's say your 4-to-1 risk to reward, this was where your 4-to-1 risk to reward ended. Okay, now I've been talking about risk to reward. I need to show you guys what it looks like, because it's actually a tool that you use in trading. You can see it. This is these things: long position, short position. So depending on which position you are taking, you can use any of them. So let's say we are going to take a short position. So you place it, let's say somewhere here. Good. Now this is your risk to reward ratio. This is a tool that helps you to calculate your risk to reward ratio. So let's say we have our stop loss around here. So you can see that this risk to reward is a 2-to-1 risk to reward ratio 2. You understand? So this is what your risk to reward looks like. This is the one I tell you that you can't change, because before you were able to get this risk to reward, you calculated the price from your entry to your stop loss, and in calculating that, you had a fixed entry and stop loss, and with that fixed entry and stop loss, you were able to now get your risk to reward ratio. Now, after getting your risk to reward ratio, you don't get to adjust this risk to reward. The only thing that you get to adjust is structure. Okay, so let's say okay, this one has already hit target. If this was an actual trade, it's already hit target here. So I'm going to just adjust it further down. So let's say it's a 3-to-1 risk to reward trade originally. Now, I said your risk to reward ratio should not change, but your structure, your targets on your zones of interest can change based on new structures formed. So you can see that, okay, let's say price hit the 2-to-1 target, but it began to go to the upside. You understand? And this point now becomes a new point of interest, a new zone of interest for us. Let me put a line there. So this point becomes a new zone of interest for us. So therefore, it will be unsafe to watch price go up all the way, form a new structure here, and then it begins to come back to the downside, and you do not take any profits at this point. You should take some profit at this point. The reason is because your initial plan was for it to get to a 3-to-1. Now you've secured some of your profits at the 2-to-1 mark, because that was your risk to reward ratio. A 2-to-1 is inside a 3-to-1, and a 1-to-1 is inside a 2-to-1. I don't know if that makes sense. So your 2-to-1 mark was already hit, and then price decided to form a new structure there. You understand? And in price forming a new structure there, it went to the upside. It's coming down back, for instance, and let's say you had half of your position still running, and you were waiting for that remaining half to go hit the final target. It will be unsafe to just completely wait till the final target. When price gets to this point, you can secure half of that profit, since you already know that, okay, initially this was not in the plan. This structure was not in the plan initially. Price just happened to now form the structure later. So you need to also adjust as price has adjusted. You understand? So in doing that, you get to now adjust your target, and you should be like, okay, since price has formed this new structure here, price could eventually come back to this point and take off again to the upside and go and hit your stop loss finally. You understand? So you should be able to be disciplined enough to say, okay, yeah, since price has decided to form this new structure, it was not in the plan before, so I guess there is something, there is a fight going on here between buyers and sellers, and it will be best to stay safe. So in safeguarding your capital, by the time when price comes back all the way down here, then you should close most of your profit again, and then you can let the remaining one run to your final target. So that's what I mean when I say your risk to reward is fixed, which is this, and it should not change, but your target can change based on new structure that price forms. So let's go back and look at new structures. New structures. Sometimes as price moves, it forms entirely new structures that tell a new story, which is what I just explained basically. I guess I've already explained this. So sometimes as price moves, it forms entirely new structures, and these new structures give you something very important. They give you sometimes an invalidation point. Now that's the point where the trade idea is no longer valid. So when new structure forms, you need to reassess everything, because new structure means new setups, new invalidations, and new opportunities. Sometimes price is literally signaling you to adjust stop loss, take some profits, or even get into the market again. Now what do I mean? New structure means new setups and new invalidations and new opportunities. So if we go back on this chart now, you would see that, okay, so now I said new structure means new setups, sometimes new invalidations, new opportunities. So for instance, price came all the way down here and began to move to the upside. So let's assume that this is a new structure formed. This point is a new structure formed. So it would mean that if price gets to this point again, it's a new structure. So like for it to be a new structure, I'm just using this as an example, but in real life scenario, you have to go on the bigger time frame that you're using for your analysis to confirm that the structure was actually significant enough to show some reaction on the big time frame. So having done that, and let's say we did that and we saw that this was a structure, you understand, assuming, it means that this point now becomes a new resistance point for us, where market came and market started to drop. You understand? So we could actually say, okay, since market came here and began to drop, this is a valid point, and we can use this valid point to now determine a new point of invalidation for the previous entry that we had, or the previous setup that we had. So when you decide that okay, this point is also a point of resistance, then you can now, based on this structure, do a reanalysis, another analysis, reassess the whole trade, reassess the new structure, and you will probably find out that okay, maybe your stop loss now is safe to adjust it to this point, for this trade. You understand? So it works like that sometimes, where a new structure gives you reason to reassess the whole trade, reassess the whole setup, and just have a new invalidation point. You understand? And then you could also have a new setup. So for instance, this point is a point of resistance. So if price eventually comes all the way up here and gives us a signal at this point, obviously that means that we should get in on this trade. But mind you, you should never be risking more than 1% on a single pair. So what pair is this? This is Euro USD. So if I already risk 1% on this trade and I get another signal to enter, and I'm still on my full risk on this trade, which is a full 1%, for instance, I shouldn't look at the trade at all. I shouldn't look to get into the trade. I should just let it pass. But in this case, we already took some profits and all of that, yada yada. So like, by the time when you are going to get into this new trade, you have to consider this. So let's say this trade, your remaining position on this trade would give you a 0.5% loss if it eventually hits your stop loss. Then you can take another 0.5% trade with this new setup, and together the whole risk on this particular pair will still be capped at 1%. I hope that makes sense. And I said it also presents new opportunities. So new setup, new opportunities, the same thing basically. So you could actually get another entry. You understand? So these structures are often what determine, where you take partial profits, where you cut your losses, and whether there is another entry within the same trend. So like I've already explained, this for instance was a structure that was formed, and if price eventually should come down back here, we should be looking to take partial profits at this point. Or like we said, our stop loss was initially somewhere here, but depending on the new structure that you have, you could actually have your stop loss adjusted. As long as you already have your stop loss adjusted, you've already cut your loss. You understand? So for instance, I now have my stop loss here. My loss has been cut. You understand? Because I'm not going to lose the initial amount I'm going to lose if I allow price to get to that original point. You understand? So that's how you cut your losses. And like I said, some would want to do it manually. They just watch the trade, and by the time when price is around somewhere here, they just close it manually because they know that it's been invalidated. We are basically doing the same thing, just using different approach. You understand? So that's it. Now let's go back. Now, risk management and lot size. Now, you can't talk about trade management without talking about risk management and lot sizing. What is it? This is simply how you choose to protect your capital per trade to make sure your account survives in the long run. Like I said, you can't talk about trade management without talking about risk management and lot sizing. Risk management is simply, how you choose to make use of your capital to survive in the long term. So let's say, for instance, you have a $10,000 account and you decide, okay, I want to be risking 1%, which is the ideal risk management standard for every trader. 1% of your capital. Now let's say you decide you are risking 1%. Per trade, it means that per trade you should not be losing more than $100 on a single trade. That's what it simply means. You understand? And lot size is what actually allows you to control that risk. So your lot size is what will make sure that instead of losing $1,000 out of $10,000 on a single trade, which is 10% of your capital, lot size, when you use your lot size and position sizing properly, you get to shrink your loss and manage it effectively how you want it to be managed. So your lot size will now determine, okay, I'm not risking more than $100 on a single trade. This is how I'm going to go about it. And your lot size comes in. Your lot size is what we now determine that, okay, this is the amount that is going to be lost regardless of how many pips the stop loss is. This is the fixed amount that is going to be lost on this trade should the trade eventually go against you. So whether your stop loss is 100 pips or your stop loss is 20 pips or your stop loss is 50 pips, you can have a fixed lot size. No, sorry, not a fixed lot size. I'm sorry about that. That is very wrong. You should not have a fixed lot size. You should have a fixed percentage that you use for all of these trades, regardless of the amounts of pips that is involved in your entry to your stop loss. Do you understand? So for instance, you have a trade that is 50 pips, your risk should be $100. If you have a trade that is 100 pips, your risk should be $100. If you have a trade that is 20 pips, your risk should also be $100. Now, when you do that, you are actually being professional and you are helping your capital to stay safe instead of using a fixed lot size. So when you use a fixed lot size, by the time when you have a loss of 60 pips, you are going to lose, let's say you lose $60 with 60 pips because you are using a fixed lot size. By the time when you also lose a trade with 20 pips, you are also going to lose $20. By the time when you lose a trade with 100 pips, you are going to lose $100. So you can see that your risk is now, is now wavy. It's now over the place. It's just all over. You're just risking and losing money differently. I don't know if that makes sense, but you shouldn't do that because in the long run it's going to affect you. You understand? And the reason why it's going to affect you is because you are not using a fixed percentage. You should be using a fixed percentage. Using different lot sizes, like using a fixed lot size for all your trade, is going to give you irregular losses that you cannot control. You understand? So lot size, like I said, is what allows you to actually control that risk. They work together hand in hand. Once you decide how much you want to risk, your lot size is what makes it possible. So for example, 0.01 lot size is equals to $0.1 on a standard pair. 0.1 lot size is equals to $1 per pip. So what are pips? Pips are these numbers that you see here. So from 350 to 400 is about 5 pips, if I'm not mistaken. Yes, it's 5 pips. You understand? So by the time when you calculate what you like, if you calculate the distance, let's say from your entry to your stop loss, let's use this as an example. So let's say 780 to what, 640, 650. Okay, let me just use a round figure. So let's say 17800 to 17700. the difference between 800 and 700 is 100, right? But you have to remove 1 out of all the zeros. So like for instance, you have 100, but when you take out 1 0, you now have 10. So you should understand that that means that this is a 10 pips movement from 800 here to 700 here. It's a 10 pips movement. So 0.01 lot size it means that it's going to have a $0.1 effect on your account per pip movement. So when you have for instance 850 to 849, yes, so when you have 850 to 840 for instance, that's 1 pip, you understand? And from 850 to 840 being 1 pip, it means that you are going to have, if you use a 0.01 lot size, you are going to have a $0.1 effect on your trading account between 850 to 840. I hope that makes sense. 0.1 lots, it will be a $1 effect on your account between 850 to 840. 1 lot size, it will be a $10 difference or a $10 effect on your account from 850 to 840. And that's just how it goes for standard pairs like Euro USD. While a lot of other pairs, it varies, you understand? But to just avoid using your own brain to do all of this, there are tools that have made these things easy. So one of the tools I would highly recommend is my FX book. When you go to my FX book, there is a calculator section, and in that calculator section you can actually calculate your lot size, the amount of lot size that you should use for you to risk a particular percentage of your account. Now, okay, let me illustrate something again. Now let's say you have $10,000 account, and you decide to risk 1% per trade. That's $100. If your stop loss is 20 pips, then your lot size needs to be set so that when price hits your stop loss, you only lose $100. So in this case, 20 pips, and you are trying to risk $100. So you are simply going to be like, pardon my drawing. So you are simply going to be like, okay, 20 pips, but you want to risk $100. So 20 divided by 100, you are going to get 5. So 20 times $5, 20 times $5 is going to give you what? $100, which means that your lot size would be 0.5. Now, why will your lot size be 0.5? Because 0.1 is equals to $1, like I said. So for you to have $5 per pip movement, you are going to use 0.5 lot size to achieve a $5, because 0.1 is $1. So to achieve $5 per pip movement, you have to use 0.5, which is times 5 of 0.1, which is $1. I hope that makes sense. So that's how you get to calculate your risk management and position sizing. So if, let's say, it was 30 pips, a 30 pips movement, you understand, and you want to risk $100, you're simply going to be like, actually you can avoid, you can definitely just avoid all of these things. I just want you to have an idea so that you don't just go into the risk management calculator and you're just pressing buttons, not knowing why you are pressing those buttons or why it's giving you a certain result. So if it was a $30 pip, if it was a 30 pips movement, would just be like, okay, 30 divided by 100, and whatever you get is what you are going to times by that 30. So let's say 30. So I'm sure if 30 goes into 100, it's going to be about 3.3. Let's just say 3.3. So 3.3, 30 times 3.3, as you should know, that's going to give you $99, which is basically the same thing as $100. So that's how you calculate your position sizing, to make sure that you are on a fixed risk for every trade, which will help you in the long run. Now, risk management is not just about minimizing losses, it's about positioning yourself to win more than you lose. That's what risk management is all about. Positioning yourself to make sure that your wins are outperforming your losses. And if you are risking $100, your target should be at least 40 pips, which gives you a 2-to-1 return. We're still using this example of 20 pips that I talked about here. This one, we're still using this example of 20 pips. So if your target, if your stop loss from your entry to your stop loss is 20 pips, then your target should be at least 40 pips. Although there are traders who still make money by using a 1-to-1 risk to reward. So they are risking 20 pips they are risking 20 pips for a target of 20 pips. There are also traders who use a 1-to-1.5. So they are risking 20 pips for a target of 30 pips. And just like that, they could actually make money because they have a very high win rate. They have a high win rate, so they can afford to. But traders, a lot of other traders would advise that it doesn't make sense. You understand? But that's the beauty of trading. It actually doesn't matter. Honestly, it doesn't matter. I've seen traders who use a 1-to-1, who use a 1-to-1.5. I mean, personally for me, when I take a 2-to-1 risk to reward trade, the money I'm actually going to make from that trade will be around 1.5 or 1%. You understand? Like, I'm risking 1%. For instance, I risk $100. By the time when I close partial profits and do all of that, by the time I'm leaving the market with profit, I might leave with just $100, which was what I initially risked, or 1.5 or $150. You understand? And that's just how the market works. For a trade of 4-to-1 risk to reward, I could end up leaving the trade as if it was a 2-to-1 risk to reward trade, due to the fact that I closed partial profits and all of that. You understand? So it doesn't really matter that much. You understand? Just make sure that you have at least a 1-to-1 risk to reward, and your win rate should be high. It should be good. Like, if you have a 60% win rate, you are good. You're actually going to make money. You understand? So I just felt I needed to explain that. So your target should be at least 40 pips, which is for my own personal trading system. And that means if you lose $100, you lose $100 if you are wrong, but you would make you should make $200 if you are right. That is, if you let the trade run to the final target without touching any partial profit, without closing any partial profit. You understand? But that is not ideal. I really do not support that. So I would prefer that you close partial profit. Yes, your profit is going to be reduced compared to what you're supposed to make, but in the long run, you are going to see how closing partial profit actually helped you save your account from a lot of losses. So that's why you will see that a trader who is very good with a high win rate and all of that, and a trader who you think is just average, when you interview both of them, you are going to find out that they both have almost the same ROI targets for a period of time. So for instance, a trader who is very good, who you think is catching 10 to 1 risk to rewards and all of that, you could interview that trader and he will tell you that I target 5%, risking 1% every month, or I target 6%, or I target 7%, risking 1% every month. You understand? Maybe some could go as far as telling you they target 10%, but ideally your target should be around 5% every month, risking 1%. Now, every trader, you see a lot of traders promising very crazy ROI. That is why they don't stand the test of time. That is why a lot of them, you get into their classes, you get into their courses and all of that, and you really don't see much value there, because they are just promising what they can't give. An ideal trader should have a ROI target per month of at least 5%, around 5%. Now, by the time when you compound that for the year, you would have a 50 to 60% return on investment, which is crazy, which is absolutely crazy and mind-blowing. So it now depends on the capital that you deployed. You understand? So that's why they will tell you that trading needs a lot of capital, because the ideal trading does not give a very high return on investment like it's being shown on social media. It's a very balanced return on investment, around 40%. A trader who comes out with 40% at the end of the year is a good trader. You understand? A very, very good trader. So it depends on how much he used. So for instance, a trader who was using $100,000, he had a $100,000 capital, you're going to leave the year with $40,000 in profit. So compared to a trader who is risking $1,000, you are going to leave with only $400. So it depends on your capital. You understand? So this is how professionals stay profitable, even if they don't win every trade. You understand? And that's just it. So let me go over everything that we've talked about today. Now, we talked about stop loss adjustments, and we said when it comes to stop loss, you have two options. You either cut the trade manually, or you adjust your stop loss based on new price action. And for your take profit adjustment, before you enter a trade, your risk to reward should already be defined. You should only adjust based on new structures and not just emotions. And that took us to how to apply these zones of interest and risk to reward when adjusting the targets. And we said risk to reward targets are fixed and should not change, while on the other hand, targets on zones of interest can change. And that brings us to new structures. Sometimes as price moves, it forms entirely new structures that tell a new story, which should help you know what to do and how to reassess your trade and your setup and position to make sure that you are not losing money. And we also talked about risk management and lot size, which is simply how you choose to protect your capital per trade to make sure that your account survives in the long run. Now, entries get you into trades, but management is what pays you in the long run. Master this and you will stop trading like a beginner. So guys, this is it for this video, and I do hope you enjoyed it. Please make sure to like, subscribe, share, and I'll see you in the next video, because in the next video I'm going to be talking about something that a lot of traders also need to understand, which is going to be the last topic I'm going to treat in this series, and it's going to be put into a single course. So turn on your notifications and I'll see you in the next one. Bye chatters.